I'm Larry Chester, the president of CFO Simplified, and we work as part-time CFOs for small to mid-sized companies. And in addition to doing part-time CFO work, we also do QuickBooks setup and bookkeeping and QuickBooks payroll. And we also do executive search with the lifetime guarantee. But you didn't come here to hear me talk about myself and my company. You came to learn something. So I appreciate your joining us to take part in our webinar this morning on cash flow management. We're going to be talking about something that's near and dear to the heart of every business owner. And if it isn't, then it probably should be. That's cash, how to manage it, how to understand its reports, and how to forecast it. So today's topic is beyond the basics. The term basic can really be different for everyone. So if this doesn't fit with your background, if it's too advanced, then please let me know and we'll fill in the blanks. And the other thing is, please ask questions. If there's something that you have a question about, just ask, because I can promise you that you're not the only one who has that question. So if you do have a question, just add your question to the chat and Amy will pick it up and let me know about it. And if you don't get to it during the session, I can always follow up with you afterwards. You already have my contact information, so if something comes up after this session and we didn't cover it, please feel free to send me an email when this is all done and I'll try to get right back to you. So here's our agenda for today. We're going to be covering 3 topics. The first is on managing your cash flow. In this day and age, running out of cash is an ongoing problem for many businesses. So we've put together a list of do's and don'ts to help you manage your cash flow. Some of these are obvious and some may not be, but it's always good to get a refresher on something that's this important. Next, I want to cover something that most business owners gloss over, and that's their statement of cash flows. This is one of the 3 primary financial reports that every financial software product produces. We know from experience that every business owner looks at their income statement, that's their profit and loss statement, regularly, and they look at their balance sheet less frequently, and rarely, if ever, do they look at their statement of cash flows. Well, I think it's time you learned how to read this report, and so we're going to cover that. And then we're going to be talking about building a cash flow forecast. Now, this is something that we do for our clients, but it's something that really you can do for yourself as well. It doesn't need to be really detailed to tell you what you're going to need in the next 6 weeks to the next 3 months. Plus, I'm going to make sure that we have time for questions before this is all over. So let's talk about cash flow planning. I think probably my favorite story about cash flow gone wrong is about a prospect that I had been chasing for 3 or 4 months before he finally decided to call me on a Tuesday to ask if I could start working for him on Wednesday. So I arrived at his plant and the CEO ushered me into his office. And as he closed the door behind him, he breathed a sigh of relief and turned to me and said, "You know, I'm really happy that I finally have you as my CFO. Your first job is to figure out how we're going to cover payroll on Friday." Seriously. I mean, our goal here is to give you the tools that you need so that you don't ever face that kind of a situation. So we're going to give you some things to think about when you're short of cash. We're going to cover 12 things to do and then 12 things not to do when you're short of cash. And then we're going to take a look at some tools that you can use to see where your cash is going and how much cash you're going to need during the weeks and months coming up. And 2 of those tools are the statement of cash flows and the cash flow forecast. And I'm even going to show you how to build a cash flow forecast of your own. So now don't worry about taking notes on these 12 tips that I'm going to give you, because we have a packet with all 24 of these tips that I'm going to send to you as a thanks for spending your time with me today. And it's also going to be available on our website. So let's talk about the do's of properly managing a cash flow shortage. If you're borrowing from the bank, ask for an overadvance. That's the first thing. I've always said that there's only one thing that a bank hates more than bad news, and that's surprises. So don't surprise your banker. Explain why you need the extra money, how soon you're going to be able to pay it back, and how you're going to keep from it ever happening again. Call your customers and ask them for early payment on an invoice that's due next week. You don't need to give them an explanation. All you have to do is say that you're working on your receivables and you would like to get that check as soon as you can. Also, you can ask your customer for a prepayment or a deposit on their next big order. Now, if they complain they've never had to give you a deposit before, you can tell them that a supplier of yours uh, that's giving material for the job that you're doing for them is asking for a deposit and you'd appreciate their help. And then the other thing is you can hold off on paying everything except for your payroll. Unless you've already stretched everyone to the limit, you can always stretch everyone for another 2 weeks or even 4 weeks without asking or needing to give them an explanation. And if they call to ask for the payment, you can always say that you'll send them a payment in 2 weeks. You don't have to give them a date that you're not going to be able to definitely send that check on that date. You can just give them a general 2-week timeline. And if you've made a promise to pay a supplier money, call your suppliers and ask them for a 2-week delay in paying that next invoice. You don't want to miss a promised payment date. And you can always look at your insurance payments or your rent payment or any other scheduled payments and pay them the day before they're late and the day before you would incur late fees. But stretching that extra 5 days can be very important if you're really short on cash. You can always ask your suppliers if you can pay them by credit card. That automatically gives you an extra 30 to 45 day terms that you wouldn't have had otherwise. And you can continue to pay or should continue to pay your critical suppliers. If they can shut down your business because they won't ship to you, then whatever happens, don't be late paying them. And always be sure to keep a clean record with a few suppliers no matter what. This way you can always use them as a continuing credit reference. Pay the absolute minimum on your credit card payments for the next few months until things start to loosen up a little bit. It may cost you a little bit of interest, but you can always use that cash for more critical purposes like payroll. Take out a cash advance on your credit card. Most credit card companies have a program of allowing you to get cash advances, and the rate may be a little bit higher, but it's always a ready source of cash that you can use. Credit cards are also offering many balance transfer options, and you can cash that balance transfer check, which will give you nearly free money for anywhere from 12 to 18 months, depending on the program. Now, there's usually a nominal issuance fee of 3 to 5%, but just be careful that you watch out for that cutoff date when they start charging you real interest, because that interest rate can be pretty heavy. But it gives you some extra time to plan and take care of your company's needs when things get critical. And you won't have to pay it off for nearly 12 months and then only make minimum monthly payments that are due, and then your cash flow ahead. So now let's talk about the things you shouldn't do when you're short on cash. First thing is, don't make promises that you can't keep. Your promise is the result of a good faith negotiation. If your promise has no meaning, then it's like the boy who's called wolf. Next time, no promise is going to work. And once you've made your promises, don't break them. Your reputation is a key asset. Keep that in mind when it comes down to it, and your integrity is the only thing that you have to sell. Don't squander it. Don't lie and don't exaggerate. To be honest with you, reality is bad enough. Just explain the situation. Every business owner has run into problems before, plus it's impossible to remember what you told them last time, so you're better off just sticking to the truth. And don't depend on reading just your financial statements to figure out how your business is doing. Certainly they're important, but they don't tell you the complete story of how your business is doing. Understand your cash flow. Understand that your income statement might say you're profitable, but that doesn't mean that you have enough cash in the bank to run your business. Don't delay reconciling your bank account. That's really the true test of how much money you really have. It's the truth behind all of your business activities. You might have miscoded an AP invoice or forgotten to enter a payment that you've made, but the bank statement doesn't lie or forget how much cash you have. Don't ignore small expenditures. They can add up really quickly. Is that new order for office supplies or that new web-based service really necessary? To be honest with you, that extra $100 a day for a business doesn't sound like an awful lot, but that amounts to an extra $3,000 a month. Don't overdraw your bank account. You're better off not paying your suppliers than bouncing checks. That's the fastest road to having them change your terms to cash in advance, which is the bane of every business owner's existence. And don't live in the float. If you send out checks hoping a deposit will save you in a nick of time, you're really walking on very, very thin ice. First of all, you're depending on something that you don't have any control over, getting a check that somebody else is sending you. Plus, it doesn't buy you much time. Nowadays, checks clear the bank in only 24 to 48 hours. And don't delay paying the government, whatever you do. They'll give you fair warning, but if you get that kind of a warning, don't ignore it. When they don't hear from you, their next step might be to put a lien on all of your accounts. An IRS lien is going to lock up every account you have instantly, and they're not that easy to get released. Don't mess with your payroll. You must pay your employees, pay your payroll taxes, and make your 401k payments. Remember, the payroll deductions for 401k contributions are your employees' money. Don't steal from them. Make those deposits to their accounts as expected. Also, keep using your payroll service. That's going to keep you honest. And don't send out checks without a signature. I mean, I know that sounds funny, but people do it. First of all, it's annoying to the people who are expecting to get a check from you, but primarily it's just plain dishonest. Don't purposely overdraw your credit line. Your bank has no patience for you not managing your cash and depending on their largesse to keep you afloat. Especially in difficult times, they will give you a little leeway, but the bank will end up bouncing your checks, and that will cause a very difficult domino effect. Well, there are two primary tools you can use to plan your use of cash in your business. The first is financial reporting, and the second is cash flow reporting and planning. And that's what we're going to talk about now. There are three financial statements that are key to your keeping track of your numbers, and you should be familiar with all of them. Your balance sheet tells you the value of your business at any one particular point in time. Your income statement gives you the financial results of your company during a particular period of time. And your statement of cash flows tells you where your company's money is coming from and how it was used during a particular period of time. Now, my experience is that most business owners are fairly familiar with the income statement, comfortable with most aspects of their balance sheet, and generally don't know what to do with the statement of cash flows. I don't want to spend a lot of time today going over all three of these documents, but since we're talking about cash flow, I think we should spend a little time talking about that one report, the statement of cash flows. Now, it's important to look at these reports because they give you information about two time frames for a particular activity, historical and future. You need to understand fully how your company has operated in the past during whatever period you're looking at, whether that be monthly or annually. But you can't drive a car by looking in the rearview mirror. You need to look at what the future might bring as well. So to look at historical usage, how your company has used cash previously, we need to look at that statement of cash flows. Where did you get the money that you've used over the past period, whatever period you might be looking at, and where did you spend it? How actively you look at your bank balance or your credit line usage, that will tell you something about the cash that you have available. But other than looking at the expense side of your income statement, do you really have an understanding of where your money came from and where it's been spent? And there's another report, a planning report, that's just as important. It tells you where you can expect to spend your money over the coming weeks or months. That's your cash flow forecast. Now, this is something that you're going to need to create. It's not something that your financial software is going to be able to make available for you. You will need to predict how you're going to manage your business over the next 13 weeks or even 6 months. And that's even more important for you because this will allow you to do some planning. And because it's better for you to know that you're going to be short of cash for payroll in 6 weeks than it is to suddenly find out that you don't have enough money to cover payroll this coming Friday. So here's an example of a sample cash flow statement, a statement of cash flows. Remember that this is a display of the cash side of your business. There's no accruals here. This is really displaying the money that went into your business and out of your bank account. What you want to see is where that money came from and where the company used it. So let's look at each section of this pretty quickly just to see how this shows you the historical use of money in your company. So you start out looking at the beginning cash. This is the amount of the company's bank account at the end of the prior month. Add to that the net income that they've earned in the company over this past month. And we also add back depreciation since it's on the income statement. But depreciation is a non-cash expense that's deducted from gross margin along with all of your other expenses to result in operating income. So we add that back in because it has nothing to do with the amount of cash that the money made this past month. The next section tells you where the changes are in cash that result from business operations. You can see that the total line is shown as cash provided or used in operations. Here we're looking at the changes in the value of major balance sheet accounts. Each one of these is impacted by either spending money or not spending money in each one of these accounts. If the number is in parentheses, that's because they spent more money than they took in. In the case of AR, for instance, the number has decreased because you collected less money than you billed out this past month. Now that's a good thing for the future, but that has an impact only on future cash, not on cash this month. Inventory value grew as well, but that's because they spent more money to buy inventory and they bought more inventory than they used. In accounts payable, they paid fewer bills than they entered. So they used less cash, which resulted in an increase in working capital. The net result of all of these adjustments was a decrease in cash availability of $211,000. Now we move on to investments. Well, really, this isn't an investment like investing in the stock market, but it is cash invested in the business. In this particular case, it was $26,137 that was used to pay for capital equipment that had been purchased previously. Remember, we're looking at this on a cash basis, so this $26,000 is a payment that was made. Under financing, they borrowed money from the bank. This was an increase in their use of their line of credit. It seems that there are really two loans here. One was paid down by $13,233, and the other was cash drawn out of the credit line to the tune of $158,081. The net change was an increase in cash available to the business of nearly $145,000. So here it is, the conclusion. They ended the month with $11,208 in the bank after starting the month with $103,791. Now, if there's one thing that's most notable, it's that in spite of the fact that they had net income of $160,000, they lost over $92,000 of cash availability. They only have $11,000 available at the end of the year. At the end of the month, because they borrowed $158,000 from the bank. Now that's the lesson to be learned here. It's not net income that allows you to run your business every month. It's cash flow, cash availability. So let's look at how the company did last month. It's a good start to understand why you need to do a cash flow forecast, because you want to plan ahead so that this doesn't keep happening to you. If every month you had to borrow $158,000 from the bank to stay afloat, as the company did this month, you wouldn't be floating for very long, now would you? So let's look at how you plan for cash that you can spend. Now let's talk about how to build a cash flow forecast. And it doesn't involve a crystal ball, although I'm sure there's a few of us that wish we had one. So when you build a cash flow forecast, you need to decide a couple of things before you start. First of all, how detailed do you want it to be? Do you want to enter each invoice, each payment, each cash receipt? Or do you want to enter a weekly summary? There's more work involved in doing the detailed work of listing each item, but it also provides you with a more accurate view of what your world of cash is, and it's easier to update. Next, you want to be able to figure out how long a forecast you want to be able to use. The standard is a 13-week cash flow forecast. The reason is that 13 weeks is a full quarter of the year. In this day and age, we're really recommending to our clients that people put together a 26-week forecast. The reason is that things are so uncertain that you need to plan out, I think, a bit farther in advance than just 13 weeks to see how your cash needs are going to be, even if your source of cash may be uncertain. So you can create your own cash flow forecast really by just doing 4 steps. And here's how we build one. The first thing is to plan it. Decide how you want to work, either detailed or summary, and gather the information that you're going to need to fill in that spreadsheet. Second, build it. Create the spreadsheet and the worksheets that you need to be able to manipulate the data. Just create the grid right now, the columns and the headings that get your sheet ready for data to be entered. Be sure you enter the formulas as well. Know that this is the time now to be able to make everything and make sure that everything is working. Then test it. Before you enter your data in the spreadsheet, enter some simple numbers to make sure that the calculations work, that the totals appear on the summary sheet at the front of the spreadsheet, that first tab. It's much easier to check out your formulas before you actually enter all of the data. Then update it. Once you've created it, the data is all in the right place. You need to make sure that you update it regularly. This really falls into 3 different tasks. First of all, you need to update the plan that you've created with the actual numbers once the week is over. This keeps the forecast accurate. Secondly, if the numbers aren't close, you need to figure out what you need to change. Are all of the formulas correct? How has the actual data that you've experienced, the actual results of your company, varied from the plan that you had created? Did you spend more money than you had planned on? Did you get less collections than you had expected? That part of the work is really harder because it makes sure that your assumptions are correct, and this will make your forecast more accurate as a tool going forward. And third, you need to extend that forecast. If you're producing a 13-week cash flow forecast, you should always make sure that you have 13 weeks forward from today. Otherwise, you're going to find out pretty quickly that you only have 2 weeks of forecast left, and then it's going to take you some time to update that and add the additional weeks to your plan. Now, there are 2 important things to remember about your cash flow forecast. First of all, this is a plan. The reality is really going to be different. People won't pay you as they've promised. You will spend more money than you had expected. The numbers are going to be different, but you need to understand where those differences come from. And secondly, remember that this is cash, not accrual. This plan will tell you where the money is at any point in time. It's not going to tell you what your commitments are, invoices that you've received or invoices that you sent out. But it will tell you what checks you've issued and what cash you've received. So it tells you how much cash you have in the bank and what your cash needs are going to be. So your first step really in creating a cash flow forecast is really as personal as the person who's creating it. They can be very complex or very simple. Now here's a simple example of the way a cash flow forecast can be formatted, and this is the way I do it. It doesn't necessarily mean to be the way that you need to do it, but like I said, every spreadsheet is different and every person is different. So the spreadsheet that you create may be different or it may be similar, but the important thing is that it includes all the cash that's going into and out of the bank. Now I like to create a forecast that has a separate worksheet for each category of information on your spreadsheet of cash flow. So I generally use at least 4 worksheets in my cash flow forecast spreadsheet. The first is a summary page that brings all of that detail together. The second is a worksheet that details all of your incoming cash, which includes your invoicing, your cash receipts, and your loan proceeds. The third sheet is a worksheet detailing all of your outgoing cash, which includes your accounts payable, your overhead expenses, and your loan payments. And then finally, a worksheet with the detail of all of your payroll. So we begin by building your format. So your sheet may look different than this, but the information is going to be very similar. Across the top, you're going to need to put in the dates. Use one column for each week. Enter the dates so that you have a reference for the starting and ending date for each week. This way, when you're entering the invoice or payments, it's easy for you to see that you've got it in the right period. And then on the left-hand side, in the left-hand column, you're going to enter your major categories. Your cash on hand, the amount of cash you're starting that particular week with, which would be your bank balance. Your incoming cash, your outgoing cash, and the net change for that week. That's the cash flow for that individual week. So are you spending more money that you brought in? And then your ending cash, which is the cumulative total of each of these weeks. The total in the column then becomes the starting cash for that next week. So you begin each week with your forecast, cash on hand. And once your format's created, you need to start putting the information into your worksheet. So the first thing you want to enter is that cash on hand. That's your starting point. It's the amount of cash in your bank account on that Monday of each individual week. So here's your summary page with all these numbers filled in. It has each major category in the cash flow forecast. Cash on hand at the beginning of the week. You've got incoming cash. You've got outgoing cash. You've got the net change for the week, and you've got your ending cash balance at the end of that week. Now notice that in week 3 and in week 5, their ending cash position is negative. Well, that's not good, but it shows you that in week 3 and week 5 from now, you need to do something different to create a positive cash balance there. That's something that needs to be fixed. So either they need to borrow more money if they can, or defer a payment until the next week, or make calls to get a customer to pay an invoice earlier. So incoming cash on that incoming cash worksheet is made up of any cash that comes into the company. Now that's going to include cash receipts from customer invoices, proceeds from loans, for instance, an advance from their credit line, or an outside investment. So notice that we've set this up so that the invoicing is also listed on this sheet in addition to cash receipts. Now this is because it's easier to list all of your invoices and then have a set formula that copies the invoice to the next section, that's the cash receipts section, based on the expected payment date from that individual customer. Now notice that I said the expected payment date from that individual customer. Now you may give that customer a net 30-day terms, but they always pay you a net 45 days. So then what's the advantage of listing them as net 30 days on your spreadsheet? You're always going to come up 15 days short on each and every invoice that they pay. So even though it's important to understand that the customer payment terms it's even more important to list them on your cash flow forecast based on the date in which you're going to be receiving payment from them. So we show that ABC Company is net 15 days for their invoices, and we show Windsor Manufacturing as net 7 days. The two green lines that we show on the bottom, those totals, are then carried over to the summary worksheet. Now for outgoing cash, that's broken into 3 segments: accounts payable, overhead payments, and loan payments. So for outgoing cash, we're doing exactly the same thing as we did with incoming cash. We're entering the open AP invoices and using our expected payment terms to put those payments in the proper week. So we're planning for the payment that we're going to make some weeks into the future. Now the same is true for our overhead payments. Now these payments are separated from normal accounts payable because these are generally paid on the same day every month. So they're repeating payments from one month to the next with some variations in the amount of the utilities. For instance, your gas bill or your electric bill may be different this month than they were next month, but they're still going to be paid on basically the same date and with approximately the same amount. And then the final section is for loan payments, which will show up in the summary sheet on the week in which they need to be paid. So each of these numbers is highlighted in red. That's carried over to the summary sheet. The payroll worksheet shows not only the payroll payments, but also the state and federal tax payments. Now, they don't always get paid on the same week as your payroll. And since we're planning for cash needs here, you want to make sure that you put in your tax payments listed in the week that they're actually occurring, not in the week that you've issued your payroll checks. So we carry over that total expense on that bottom line total payroll into the summary worksheet. So here's the summary page again. Now that we've looked at this in detail, this might make a little more sense. Each of these numbers is carried out here from the detailed worksheet that we've gone through just a moment ago. The blue numbers are the numbers that are added together to give you the net change here, where in week 1, the outgoing cash has exceeded incoming cash by $1,400, as you can see. But we've had some earlier cash on hand of $3,500, so that leaves us with an ending cash total of $2,083. Now, each week allows you to see where your money's going and where it's coming from, so that you can plan for when you will be short of funds, as in week 3 here, they're going to be short by $246, and what you need to do to make sure that you have enough cash to cover payroll, pay your critical vendors, or make sure that you have enough cash for your loan payments or your payroll. So that's all there is to putting together cash flow. Well, not really, but it should give you a pretty good introduction to the whole concept. Now, we've discussed the do's and don'ts of being short of cash, and we've talked about cash reporting with the statement of cash flows, and we've also talked about how to build a cash flow forecast. I hope this has been important and very helpful for all of you. So I wonder if there are any questions that we can address. Amy, you there?
I am. I don't see any in the chat box right now.
Okay. So if anybody has any questions, please feel free to send me an email in the future. You have my email information. It's right here on the sheet. Giving you my email address or even my phone number if you wanted to call me directly. I look forward to hearing from each of you if you have any questions or issues. Thanks very much for attending our webinar today.